right now, massive institutional money is kind of just blindly pouring into Bitcoin ETFs at the exact same moment that, well, historical doom loop chart patterns from 2018 are flashing blood red.
Yeah.
So
Yes.
someone is about to get liquidated, right?
Oh, absolutely. It's the ultimate staring contest between just unprecedented Wall Street capital and deeply entrenched market psychology.
Right.
One of these forces has to break, and the entire market is just holding its breath, waiting to see which one it is.
Well, welcome to today's deep dive. Our mission today is to synthesize a really critical snapshot of this exact moment in the crypto market. So we're looking at August 28, 2026, and we are pulling from a heavy stack of sources today. We've got a market newsletter titled A Critical Moment for Crypto. We've got some deep analytical summaries covering Benjamin Cowen and the Bankless crew, plus a news roundup.
Yeah, some wild headlines in there today.
Yeah, totally. The latest industry headlines featuring Visa, Ethena, and of course, a massive DeFi exploit. So we are looking at a market where Bitcoin is hovering at this precarious $80,000 and Ethereum is clinging to 2,500.
Yeah.
And we really want to answer one pressing question today. Is this space on the verge of undeniable, permanent institutional integration?
Or are we getting dragged backward?
Exactly. Are we getting dragged backward by the ghosts of previous bear markets?
Yeah, and setting the stage with those numbers is really crucial because, $80,000 for Bitcoin, it isn't just a random psychological barrier.
Yeah.
It's the literal line in the sand for short-term market structure right now.
Okay.
The newsletter we're analyzing, it lays out two very distinct scenarios for the days ahead. So scenario one is a definitive break above 82,000.
Which would be huge.
Right. If the market achieves that, it likely leaves all the sideline dip buyers just completely stranded as we move higher.
Oh, wow. Okay.
But scenario two is a failure to hold 80,000, which would trigger a swift, 10 to 15% correction.
Okay, let's unpack this for a second. Because the authors of the newsletter actually state that they want scenario two.
Yeah, I know.
Which, to anyone managing a portfolio right now, rooting for your assets to drop 15% sounds absolutely insane.
It does sound crazy, yeah.
But they argue this correction is necessary for Ethereum to form what technical analysts call an inverse head and shoulders pattern.
Right.
Basically, it's a visual map of seller exhaustion. So you get a low point, a lower low, and then a higher low.
Exactly.
It flushes out the weak hands and builds a concrete launch pad for a sustainable rally.
Yeah.
Rather than just a fragile spike that
collapses under its own weight.
Right, exactly.
And that structural argument makes perfect sense in a vacuum.
Sure.
The tension here arises because those clean textbook chart patterns are colliding with a completely non-traditional wall of money.
Yeah.
We are looking at 9 consecutive days of positive inflows for both the Bitcoin and Ethereum ETFs.
Which is just staggering.
It is. Wall Street asset managers are just indiscriminately buying the dip every single day, completely ignoring the technical setups that, usually govern these cycles.
Right. And if you look at the summary of Benjamin Cowen's latest analysis, that clash between new money and old cycles gets downright eerie.
Oh, it really does.
Yeah. Looking at his 2018 chart overlay compared to today's price action it's like watching a ghost walk the exact same path through a haunted house.
That's a great way to put it.
You know exactly which floorboards are going to creak.
Yeah.
February low?
Yeah.
Check. A higher low in March? Check. A lower high in May, followed by a brutal summer sweep down to 57,000? Check.
Yeah.
And now we are rallying right back to the 50-week moving average, which is this massive momentum indicator tracking the average price over the last year. And we're exactly on schedule, just 1 month later than the 2018 timeline.
Yeah. And Cowen-Orr's analysis highlights that 80,000 to 85,000 zone as the ultimate exorcism for that 2018 ghost.
Yep.
If Bitcoin can secure multiple weekly closes above that level, well, the bear case disintegrates. The pattern is broken.
Right.
But a rejection here mirrors the exact trap we saw in 2018 and even before that, in 2015.
I have to push back on this reliance on historical charts, though.
Sure.
Are we putting way too much faith in lines drawn from 2018 when the fundamental landscape is just unrecognizable today?
It's a fair question.
Because back then, we didn't have BlackRock and Fidelity casually dumping billions of dollars into spot ETFs.
No, we definitely didn't.
That kind of relentless, automated institutional capital has to break the old models, right?
Well, what's fascinating here is that Cowen doesn't actually dismiss that new capital. His data visualizes the tug of war.
Oh, interesting.
Yeah, he notes that the weekly relative strength index, the RSI,
right,
has completely reset. meaning the market is no longer technically overheated.
Okay.
Furthermore, the supply of coins currently held at a profit versus a loss has reached levels that historically signal a bottom.
Oh, I see.
So the internal metrics actually do support the bullish ETF narrative.
The flip side of that optimism, though, is the realized price metric, which is flashing a massive warning sign right now.
Yes.
Realized price is essentially the average price at which all existing Bitcoin last moved on the blockchain.
Right.
It strips out the speculative noise and acts as a historical bedrock of support.
Exactly.
And right now, that bedrock sits at 53,000, and we haven't touched it once this entire cycle.
Not once.
Historically, a crypto market cycle doesn't truly reset until that bedrock is tested.
And you have to add the macroeconomic overlay to that, too.
Right, Jackson Hole.
Exactly. The Jackson Hole Economic Symposium is tomorrow. Federal Reserve commentary there dictates global liquidity.
Yeah.
And Cowen points out a historical certainty. In every single midterm election year, Bitcoin's final bottom perfectly correlates with a typical stock market correction of 10 to 20% in August or September.
So what does this all actually mean for us? If Jerome Powell signals tight liquidity tomorrow and equities drop, they could easily drag Bitcoin down to test that 53,000 realized price, fulfilling the 2018 prophecy.
Very easily, yeah.
But if all this ETF capital keeps flowing in, regardless of the haunted house charts, it begs a much larger philosophical question about what these institutions actually think they are buying.
Which perfectly shifts the conversation from short-term trading to the long-term macro narrative.
Right.
Which Changpeng Zhao, CZ, the co-founder of Binance, he addressed this recently.
Yeah, I saw that.
While retail traders are sweating over an $80,000 resistance line, CZ is looking at the fundamental nature of the asset. He's asserting that Bitcoin could eventually flip gold as the world's preferred store of value.
Which is just a staggering mountain to climb. I mean, as the newsletter points out, gold's market capitalization is still roughly 20 times larger than Bitcoin's.
Yeah, it's massive.
But if you look at the macro catalysts, exploding government debt, rampant currency debasement, investors and sovereign wealth funds are scrambling for strictly scarce assets.
Right.
Both gold and Bitcoin benefit from that exact same fear. But Bitcoin operates with massive logistical advantages.
Exactly. I mean, gold is anchored by centuries of history, sure, but it is anchored to physical, bulky financial systems.
Right.
Moving $1 billion of gold requires armored transports, secure vaults, armed personnel, and significant time.
Yeah, it's a huge operation.
But moving $1 billion in Bitcoin takes 10 minutes over a communication channel and costs, a few dollars in network fees.
Right.
It is built natively for the speed of the internet age.
The way I conceptualize the difference is comparing physical vinyl records to digital streaming.
Oh, I like that.
Vinyl is analog wealth. It has undeniable history, tangible value, and purists will always demand it, right?
Absolutely.
But streaming is frictionless. It is how the modern world actually moves and consumes data. Bitcoins is basically the streaming service for global value.
Taking that analogy further, vinyl didn't go extinct, but streaming completely absorbed the utility of daily life.
Right.
The critical nuance here is that the market often frames this as a zero-sum deathmatch, and it doesn't have to be.
Exactly my thought. Does Bitcoin actually need to replace gold tomorrow to be successful?
No.
Or can it thrive exponentially just by siphoning off, a 5 or 10% fraction of the fresh capital that traditionally defaults to the gold market?
Exactly.
If you're a macro fund manager, you don't have to hate gold to allocate a single-digit percentage of your portfolio to the digital equivalent.
Right. And capturing just a fraction of gold's market share would result in massive upside volatility for Bitcoin.
Jeez.
The sources suggest this shift won't happen overnight, obviously, but this current cycle is elevating the whole Bitcoin versus gold debate from a niche crypto talking point into a mainstream macroeconomic reality.
So if we accept that Bitcoin is cementing its role as the digital reserve asset, like the gold, then Ethereum is clearly attempting to become the digital financial infrastructure.
The Wall Street, basically.
Right, the Wall Street. But to get traditional Wall Street truly operating on-chain, Ethereum has to solve a glaring fundamental roadblock.
Yeah. And this brings us to the Bankless summary featuring Mo and Oscar, the co-founders of ETH Systems.
Okay.
They isolate the single largest barrier preventing traditional institutions from migrating their operations to Ethereum,
Which is
the public ledger itself.
right.
Institutions are enamored with the technology, the instant settlement, the automated smart contracts, but radical transparency is a complete deal breaker for global commerce.
Here's where it gets really interesting to me. Because if you think about how high finance actually operates, if you are a major asset manager, you cannot use a system where your competitors can monitor every single trade, track your balances, and anticipate your positions in real time.
Right. It would be a disaster.
Trying to run global financial markets on a fully public blockchain is like playing a high-stakes game of poker. But you were forced to hold your cards facing outward so everyone at the table can see your hand. You get front-run into bankruptcy by Tuesday.
Literally. And to circumvent that in the past, banks attempted to build private blockchains.
Right.
These walled gardens where only invited participants had access. But those initiatives consistently fail.
Because they're completely isolated. Right.
Exactly. Isolating yourself means you lose the entire point of the technology. You lose the global network effects, the shared liquidity, and the composability of the public mainnet.
So enter ETH systems. Mo and Oscar aren't trying to force banks onto private, isolated chains.
Yeah.
They are working directly with institutions to understand their strict compliance and trade secret requirements. And they are building privacy solutions directly on top of the public Ethereum chain using advanced cryptography.
And the summary highlights a brilliant real-world application of this concept: interdealer compression.
Oh yeah, this is fascinating.
In traditional finance, banks execute thousands of trades with each other daily. Bank A owes Bank B owes Bank C, and so on. Instead of sending thousands of individual wire transfers back and forth, they use interdealer compression to calculate the net difference of all those trades and settle just one final amount at the end of the day.
But because these banks absolutely refuse to show each other their internal ledgers, they currently pay tens of millions of dollars annually to highly trusted, centralized third-party middlemen just to do that math.
Exactly.
And ETH systems proved that you can run this entire compression process privately on Ethereum.
Right.
The banks input their encrypted trade data. The blockchain smart contract executes the math without ever decrypting or revealing the underlying positions to anyone, and securely settles the net difference.
Yeah.
It completely vaporizes the multi-million-dollar middleman.
It really does. And the technology to achieve this, zero-knowledge proofs and advanced cryptography, is largely ready today.
Wow.
As Mo and Oscar pointed out, this has transitioned from an abstract research puzzle into a straightforward engineering deployment. Institutional demand is already inbound because the operational savings are simply too massive to ignore.
I have a serious philosophical dilemma with this, though.
Okay.
Wasn't radical transparency the foundational ethos of this entire industry?
Well, yes.
The original rallying cry was, don't trust, verify. Open ledgers that everyone can audit to prevent backroom corruption.
Right.
If we spend all our engineering talent building heavy encrypted privacy layers specifically designed to hide the activities of major banks, aren't we just recreating the exact same opaque, shadowy Wall Street systems we explicitly set out to escape?
That's a great point. If we connect this to the bigger picture, you are hitting on the central identity crisis of the crypto space right now.
Yeah.
It's a direct collision between ideological roots and the pragmatic reality of global financial plumbing.
Right.
For Ethereum to scale into a global infrastructure layer, it must accommodate how global commerce legally and operationally functions. Corporations legally require trade secrets.
That makes sense.
The ultimate endgame these developers are driving toward is invisible infrastructure. A world where institutions and everyday users are trading stocks, accessing loans, and moving money globally without ever knowing or caring that Ethereum is the engine running underneath.
And that ideological clash isn't just theoretical, it's playing out in real time in today's news cycle.
Oh yeah, big time.
Reading through the August 2026 news overview is like looking at a burgeoning 1800s frontier town suffering from a massive split personality.
The juxtaposition in these headlines perfectly illustrates a technology in transition.
Totally. I mean, on one side of Main Street, you have serious institutional maturation. Visa, one of the largest payment networks on Earth, is officially teaming up with Dunamo.
Right, the parent company of Upbit.
Exactly, the massive South Korean exchange. And they aren't just dipping their toes in, they are partnering to aggressively explore stablecoin payments, cross-border settlement infrastructure, and AI-powered finance.
That is a marble bank being constructed right in the center of town.
Yes. And next door to that marble bank, you have Evernorth clearing a major regulatory hurdle.
Oh, right, the XRP Treasury.
Yep. Their SEC registration just became effective, which moves their XRP Treasury company one significant step closer to a formal NASDAQ listing.
Wow.
We are watching crypto assets being normalized through traditional corporate paperwork and SEC filings.
And you even have the crypto native projects putting on suits and ties to appeal to Wall Street sensibilities.
Right, like Athena.
Exactly. Athena just proposed a massive overhaul to their tokenomics. They're proposing directing 95% of all protocol revenue directly toward buying back their ENA token, while simultaneously ending future investor token unlocks.
Which is huge for retail holders.
It's a massive relief because it stops the constant dilution of retail holders by early venture capitalists.
Right.
They are restructuring their decentralized protocol to look and behave much more like traditional corporate equity buybacks.
So the frontier town is clearly trying to civilize itself.
Very much so.
But then you look at the headline from the Moonwell protocol.
Oh, man.
Yeah. On the other side of the street, a hacker just robbed the local saloon in broad daylight. Moonwell suffered an $8.7 million exploit on the Base network.
Yeah.
And this wasn't a sophisticated cryptographic break. It was a classic Oracle manipulation.
Right. And to understand how this happens, you have to understand that smart contracts are blind to the outside world.
Right.
They rely on oracles to feed them external price data.
Exactly. The attacker essentially hijacked the price feed for a token called Mamo.
Right.
They manipulated the oracle to make the Moonwell smart contract believe the Mamo token was suddenly incredibly valuable.
It's so brazen.
And once the contract was tricked by this fake price, the attacker used that highly inflated worthless token as collateral to borrow $8.7 million in real hard assets from the protocol.
Jeez.
It's a purely mechanical smash and grab.
It really is. And synthesizing all of these headlines brings us full circle to the bankless discussion. Well, Visa building infrastructure and Evernorth filing SEC paperwork shows us exactly where the institutional puck is going.
Right.
But the Moonwell exploit is a glaring reminder of why we aren't there yet.
Oh, I see.
BlackRock and Fidelity are not going to commit their deepest liquidity pools to this decentralized infrastructure until the security is flawless, and the privacy layers we discussed earlier are fully functional.
Right.
The frontier town has to become a fully policed metropolis before the real capital moves in.
So to bring this all home, our mission today was to figure out where we stand in August 2026.
Mhm.
The immediate market is holding its breath for Jackson Hole, waiting to see if Bitcoin leaves dip buyers behind above 82,000 or gets dragged down to test that historic 2018 ghost at 53,000.
Exactly.
But underneath that daily price action, the underlying infrastructure from ETH systems building privacy to Athena restructuring tokenomics is quietly and methodically preparing for traditional finance to arrive.
It really is.
So if you are a listener navigating this space, your goal right now isn't to perfectly predict tomorrow's chart, but to understand and prepare for these deeply contrasting scenarios.
This raises an important question, though, and it builds directly on that ETH systems concept of the endgame.
Okay, lay it on me.
We talked about Ethereum becoming invisible infrastructure,
Yeah.
like the TCP/IP protocols that run the entire internet.
Right.
You and I rely on TCP/IP every single day to send emails and stream videos, but we don't hold global conventions for it.
No.
We don't identify ourselves as TCP/IP maximalists.
Nobody is wearing a TCP/IP hat.
Exactly. So I leave you, the listener, with this thought. If crypto truly achieves its ultimate goal, if it successfully scales, secures itself, integrates with Wall Street, and becomes the invisible plumbing for billions of people who never even know they're using a blockchain,
Right.
what happens to the passionate tribal crypto culture?
Oh, wow.
When this revolutionary movement finally succeeds and becomes completely mundane, does the very culture you and I are a part of lose its reason to exist?
Wow. Does the culture have to die for the technology to succeed?
Yeah.
That is a heavy, fascinating dilemma to chew on. Huge thanks to everyone for joining us on this deep dive. Keep watching the charts, but more importantly, keep questioning the consensus. Sometimes the ghosts in the haunted house are just a distraction from the new foundation being poured right next door. We'll see you next time.